Thanks for joining. Of course, back here with Fred. Got a cool video. Going to talk about some of the holdings within Elemental, but kind of go into the acquisition strategy or kind of, how you guys choose what fits in the portfolio, the selection criteria. But first things first, Fred, how are you?
Very good, thanks. It's full summer here in the UK, so that is nice change. And actually, had my first COVID jab, so might be getting out to Canada, US, North America for some marketing second half of this year, which is I never thought I'd say it. It's how exciting that sounds, but it actually really does.
You go from traveling too much to not traveling at all and wanting to kind of do a little in between. So, no, awesome. Well, looking forward to a little bit of the road show, I guess, as it comes. But here, let's dive into it. So, of course, getting some questions. Would love to kind of just chat about Elemental in general, kind of some things in the holdings right now, and then chat about what goes into the selection criteria for new projects and kind of how you guys look for new things. So, I'll throw it to you.
Okay, so I suppose if you want to start with at a high level of how do we choose the asset? How do we decide how do we decide what to invest our money into? And one of the things about royalties are that it's not really like an equity. A stock, you can buy it and you can sell it tomorrow, and there's 100 people to trade it with. With a royalty, there is a market, but when we're buying royalties, we're looking at them as this is a marriage each time. And we're going into it thinking, is this an asset I want to be tied to for the next 10, 20 years? And that's a great thing, because when you get a really good asset, it can go start with a 10-year mine life, and it can go for a 50-year mine life. And once you've bought it, you never pay for anything again. So the operator is investing every year in CapEx. It has to deal with inflationary costs. It has to deal with new technology, exploration every year, etc. Whereas a royalty company, once you've bought it, you own it forever. So we're always looking for things and going, where will we be in 10 years, 20 years, or 30 years? So that kind of time frame, when you think about it, is really important. And when you think about things over that time period, I think that's when you can really make not just 100% returns, but when you can make 10 times plus. And it doesn't mean you have to wait 10 years, but what it does is it means that the operator is going to look at it, and they're hopefully going to see the same thing as you. And they're going to go, hey, we think this can be a 50-year asset. And the sooner we can prove that to the market, the better. And so use an example of a royalty in our portfolio, the Wahgnion royalty, and it's held by the top 10 gold producer globally. It covers 1,000 square kilometer license package. So it's a really huge license package. And they have a 10-year mine life to start with, but they're spending about $12 million on exploration alone this year. So at the end of this year, they're going to be, and probably over the course of it, they're going to be coming out with exploration results and investing to keep growing that. And the reason is not because they need it for the mine life. It's got a 10-year reserve life before you even look at the resources, but they're looking at it and going, we want to be able to demonstrate to the market this is a really long life asset. So if we invest 12 million a year over the next 2 or 3 years, we might be able to add X years of mine life onto this. And so if they can show the market that in 2 years, we added 5 years, we doubled the mine life, whatever it is, then the market's going to start looking at it and valuing it differently. And for a royalty company, we're getting paid while the resource is getting bigger, and we don't have to do anything. And that's why when you're looking at these assets and a royalty, you're looking for something that is going to be, it has that optionality into the future, and it can go and go and go.
Yeah, interesting. And maybe kick it off. It's funny, obviously we get questions. We got a question, people, they don't even realize they click on your they click on the Elemental portfolio website, or that at least the link on the website, and they go, wait, there's different types of royalties. Would it make sense to kind of talk about those quickly, and then we'll go into kind of some more of what you guys look for?
Okay, yeah, that's a really good question. So there are a number of different royalties. At the high level, what we're looking for and what we try and target generally are gross revenue royalties. and when they're dealing with gold, it's called a net smelter royalty. But effectively, a net smelter royalty is the same as a gross royalty, with maybe 1% or 0.5% of the cost taken off. And what that means is that if company A sells its product for $100, if you have a 2% gross revenue royalty, you will get $2. If they sell it for $100 and you have a net smelter royalty, you might get $1.98, but it's rounding to the decimal point. So effectively, it is a 2% gross on whether that's a net smelter return royalty or a gross revenue royalty. And then there are different types. There are, after that, there's net profit interests, and there's fixed cost, there's fixed payment royalties. So you could have something that says, I'm going to make 100 potatoes this year, and I'm going to pay you $1 for every potato. And you can have that for gold or for iron ore or for copper or zinc. And for us, it's pretty much gold. But you can have fixed payment terms, and then the net profit interest. Now, the net profit interest is the most complicated. And one of the things I would say about it is that is really dependent on the operator and the asset. So basically, a net profit interest is we will get 2%, again, let's use that as an example, but not of your top line gross revenue. We will get 2% of your profit. So that can be more variable because the company can pay a lot more than a royalty, gross revenue royalty. So gross revenue royalty might pay you $2, but a net profit royalty, if it's the same 2%, actually 1 year, it might pay you $10. But then the next year it can pay you $2. So it can be more variable and complicated. But sort of 95% plus of our portfolio is on the basis of gross revenue royalty or net smelter royalty equivalents. So that's another thing, is trying to get royalties that give you that exposure, because you can have some other royalties in there, but you want the majority as gross revenue top line because it's less volatile, it's easier to predict, and it gives you a really good baseline.
Yeah, so it makes sense. And I saw that question. I was like, wow, how perfect. Let's get Fred to go over. I think that was awesome. Obviously, thanks for doing that. So now walk me through, kind of, and we'll go into some of those things in the portfolio, but how do you make an addition to the portfolio? What does it look like? Does a company say, hey, Fred, hey, Elemental, we'd like to offer you a royalty, or is it you're buying? Like, give me the kind of dynamics on how that deal comes together.
So when we started and our history, we were a startup company. So this was in 2017. I think our first fundraise was actually $1 million, and we bought a royalty for $2 million. So we had to give away half of it to a mining private equity fund, who actually got a very good deal for free from us, it was just because we started off with $1 million. So one of the things is, when you're a startup company like that, you can't walk into the door of $1 billion mining company and say, well, what royalties would you like to sell us, or can we create a new royalty? So what we did is we focused on third-party royalties owned by someone else. So we went to some of the big companies and we said, we know that you own X royalty on this mine. It is a non-core asset for you. Maybe it was legacy interests, maybe you had a stake in the mine 20 years ago, but we'll buy this royalty from you. And so it was very, very, I think I'd call it very focused, and it was really, really specific. We weren't going out there with a scattergun approach. We could probably really double the size we are now and have, instead of 9 royalties, have 20 or 30 royalties. But there's a reason that management still have 16% of the company, and we have a quite tight shareholding structure, is because we've done some really targeted, specific deals where we looked at it and went, this is a really, really good asset that we want to be married to and tied to for the next years. And if we can get a reasonable price on it, from sometimes any companies going from private individuals all the way up to $30 billion brewery businesses. And one of the royalties we bought came from Carlton Breweries, who do Foster's beer, and they've had a gold royalty for 20 years. So that was a very different dynamic, because you're talking to someone who doesn't understand the mining world, doesn't understand the royalty, And it's a great opportunity for us and for them. They're tidying up, legacy interests that they have across their portfolio that actually take more work and effort for them. So it depends a lot on the dynamic. The dynamic depends a lot on who we're buying it from. But most of the royalties we've bought to date have been buying from non-core owners.
Yeah, interesting. And we were seeing these questions too, like, why would a company sell you a royalty? And maybe that's something interesting to touch on. I mean, you touched on one example, but maybe walk through some of the others.
Yeah, it's that's actually something we come up across when you find a good royalty. I mean, if you or I held a royalty, that was paying us $1 million a year, you might go, I can sell it, but equally I could hold it and it could be paying me $1 million a year for X amount of time. One of the things that happens is when you put a portfolio of royalties together, you really diversify the risk. And so if you have one royalty on your one asset in, let's take it as an example, in Wales, you have a mine in Wales, unfortunately the next year there's a flood, and that mine stops production for a year. Unfortunately, the year after that, you're really unlucky. There's some union unrest, there's some strikes, it doesn't pay you for 6 months. All of a sudden, that's really cost you something. And that might also damage the value of the royalty going forwards. So when you put 5 or 6 royalties or 10 or 12 royalties or 20 or 30 royalties together, all of a sudden, you can carry your way through those 1 in every 10-year events where a mine, they go on strike, or COVID happens. COVID's a great example. One of our royalties in Chile, they reduced production last year for 3 months by 25%. They actually made it up, so they hit their guidance for the year in the end. But had we owned solely that royalty, we would have been looking at it, and at the worst possible time in the middle of COVID, going, oh no, we might not get any revenue, and I've planned my life around it. Whereas when you put them together, you can access credit facilities. And we've started doing that, where you can go to banks and get really, actually, for as we grow, really incredibly competitive credit facilities, because a bank looks at you and go, you've got X million dollars of revenue, you're not operating any assets, so you've got very high margins, and you're more diversified than any other mining company. The royalty companies are the most diversified in the world. So they trade at a premium. The biggest royalty companies in the world trade at 2.5 times the sort of net asset value of the underlying assets because of that. And so that's a lot of the pitch. And one of the royalties we bought actually came from 4 of our seed shareholders, and they've held it for 13 years. And it was on Teranga's Wangyon, which is now Endeavour's Wangyon. And they sold that royalty to us, not for the best price actually that they could have got. They sold it to us because they took more equity in us, because they were shareholders in ours, in Elemental, and they could see the value uplift they could make by being part of combining royalties together. And that's our most recent acquisition with South 32. And they're a $10 billion company. I think they had a lot of choices on what to do with their royalty portfolio. And ultimately, they decided that the best way for them to realize value was to put it into us, to take a 19% stake in us. And it's the first time that they've put a director on the board of another company. And I think that says a lot about what their view on the value uplift and the value upside is. And it's exactly what we have done successfully to date, and how we built the company, which is putting good royalties together. And good royalties tend to increase in value, and when you put them together, 1 + 1 equals 2.5 instead of 2, and that kind of thing.
Yeah, no, awesome. And look, I appreciate you shedding the light like this. In a lot of circles, at least we're seeing kind of a new conversation, around royalties. So it's fantastic that, you're the expert able to shed some light. But here, back to it, I know we'll get into a lot more of this stuff case by case, maybe walk through it, more kind of nailed down, but maybe give people an overview of some of the assets. I know you guys have a bunch, maybe want to highlight your favorites, or at least, some of the bigger ones.
Well, the one that's really topical, because it's the newest gold mine in Australia, and it is due to start production in the coming weeks. So that is the Karla Winder royalty, and they had guided production sort of end of June this year. So very shortly. And I think for us, that's also our biggest royalty. So it's our biggest royalty. It's in Western Australia, which is one of the top mining jurisdictions. It will be a long life cornerstone asset for us. And that coming on stream in the next 2 weeks is probably going to be one of the bigger events that sort of that happens. And I think it's once that royalty comes on, then probably hopefully for the rest of my life, that royalty is that mine is working away, and they are making royalty payments to Elemental. So that's one of the ones I'm really excited about. And in Australia, it's not so well known in Canada where we're listed, but in Australia, it's a very well known management team. They've built two companies into multi-billion-dollar mining companies, and they bought this asset, to do the same thing again. And I am sure that all the guys there could retire if they wanted to, but I think they enjoy it. They're good at it, and that's a 2% royalty we have on it. So it's a pretty meaningful royalty once it gets up and going.
Yeah, awesome. Well, look, I think this has been a great overview, and I'm sure there's going to be a ton of questions that come out of it. So please, if you made it this far, drop your questions below. We'll dive into some of the assets themselves and kind of the winning of deals. But Fred, anything else kind of in general about royalties that you wanted to cover?
Well, it's one thing I would just mention quickly. It's interesting, but just because it's so topical, but I think it was yesterday. Actually, one of the royalty companies, Ellie Gold Royalties, was acquired by one of the mid tiers, and I think it's interesting to see that start to happen, because people have been talking for the last 6 months about some M&A in the royalty space, and I think they paid a 40% premium mix of cash and equity to acquire them, and that was announced yesterday. So it will be interesting to see sort of how that develops over the next year or year and a half. But people have been talking about it, and all of a sudden, yesterday for the first time, you got the first deal announced, and I think what's interesting about it is that's approximately a $300 million Canadian valuation they paid for it. And if you look at Elemental today, we're about $100 million Canadian valuation, but we're probably on for double the revenue they had this year. So it's a pretty good comp for us to be there, because I think it's it might not be appreciated in the market yet, but I think once Karlawinda comes on stream, literally in the next 2 weeks, it's our biggest royalty, it's our biggest asset, and I think it makes us look very good on a valuation basis.
Yeah, well, and maybe we can talk about some of the comps and other things on the market going forward. But Fred, thanks so much for taking the time. Looking forward to doing some more videos here soon.
Great, thanks, Jason.